Any advice and information from this podcast is general only. It has been prepared without taking into account your individual circumstances and needs. Before acting on any advice from this podcast, you should assess and seek advice on whether it is appropriate for your needs, financial situation, and investment objectives. And we are back again. J-Mac, hello. Hello. Can't believe it. We're up to episode 937. Eat your heart out, Joe Rogan, and all the other finance podcasts out there. By popular demand, no, not really, but we thought there's a lot we still want to cover for all our listeners, and even if it's just our clients or prospective clients, surely they are getting something out of this. J-Mac, did you ever think that all the information I guess all the things we're talking about on this podcast, if listeners just listen to the podcast 1 through to 937, that would cover everything they would need to know, and then they wouldn't need to see a financial advisor?
Ooh, big cool.
I think we're shooting ourselves in the foot here, ladies and gentlemen.
Too
but
much
anyway,
info, yeah.
yeah, but that's all right. We're here to help, and we're happy to help. So I guess this is sort of how we go about it. If you can be driving your car on a holiday from your investments you've made that's funding your holiday, it's a win-win.
Yay.
That's all right. Okay, so today, sorry to recap, we've talked about a few things, but I guess today or this episode, we are talking about dividends and what they are.
What are the hell are dividends?
Sweet dividends. Okay, this sort of rolls on from our previous episodes. We've talked about other types of investments. Dividends sort of specifically roll into kind of shares, and is something that's derived from owning shares. If you own shares or even potentially an index or a managed fund, you could also potentially reap the benefits of getting paid dividends from a company or an index. So, J-Mac, take us away and pretty much complete the rest of this podcast, starting with dividends. What are they? Talk me through it. What is this word, and how does it pay me money if I have shares?
Yay, money. Well, dividends are essentially, so if you buy, a few companies, and these companies have made a profit for, whatever it is, the quarter or the financial year, they will, if they choose to share their profits, they will give you a dividend, which is the profit of those companies between all of the shareholders, which would be you.
And so does it matter, say I own one Tesla share and you own 2 Tesla shares, will I get the same amount of dividends as you? How does that work?
No, I get more.
Damn. Okay. I'm just relating Tesla because I think one of our previous episodes we sort of highlighted Tesla as just a general example of a individual company, but there's heaps of companies out there, and we'll get to it in a second. Not all companies pay a dividend. Is that right, Jessie? Okay. So if a company's doing well and it's making revenue, which is good, but then it's turning it into profit, which is even better, sometimes a company will then opt to issue dividends to its shareholders.
When do I get my money?
Sweet Jesus. Okay. That sounds really good. So it's essentially companies sharing profits with their shareholders, which is that sounds music to my ears, I guess, and that's some of the joy of owning a property. Now, is that on top of, so a share price, as we've talked about before, can potentially go up or down? So you're saying that if a company's doing well, the share price might increase over time, and it can also pay you a dividend.
Yeah. Seems like too good to be true, hey?
Right. So that varies a fair bit from, say, if I had money in a savings account that's going to pay me 4% interest, I only earn the interest, but the value of my money in the bank doesn't really grow, does it? It can only grow by interest. Whereas if I have money in shares, are you saying that the share price can grow, so that's capital growth, and I can receive dividends, so like an income payment?
Yeah, so it's kind of similar to your house, how it grows in value and each year, but you don't know till you sell it what the growth of the
capital growth, yeah.
But then because you're in shares, you also get the profit of all the businesses.
Okay, and so with these dividends you talk about, let's just say companies realise the profit. yep, we're going to issue some dividends to shareholders. When are they paid?
They're different depending on, who you're invested in, but they could be, quarterly or biannually, so 2-4 times a year.
Okay. And usually, is that right? Sometimes you'll see that it kind of floods the media streams and the news streams. There's periods in the year where companies release their profits, and then they announce, hey, we're going to issue 10 cents to the share or whatever, depending on the company. Okay, so it can happen a couple of times a year or quarterly. It just depends on the company. Okay,
Yeah.
so that's really interesting. So you're saying I might be able to get paid in between 2 and 4 times a year.
Not bad, eh?
So if I hold this, I'm getting my head around this. If I'm holding shares, they're going to pay me, if they make a profit, to be a shareholder. But I haven't had to actually work for the company, have I?
No.
What? All right. Why didn't they tell me this in primary school? Anyway, story for another time. So do all companies pay dividends? If let's just say, all companies are making a profit, will they all then pay dividends?
No. They can choose whether or not they get to pay dividends. And the reason they might do that is maybe they want to reinvest into the company with their profits instead of giving it to shareholders.
Okay, so is that that's sort of kind of like a capital reinvestment. So say they've made a few $100 million in profit. Ooh, give it to the Fitz Fund. So they can elect to either pay dividends to its shareholders, or they can hold that few $100 million in the company and use that to expand or do further research and development, or increase staff skill. Is that right?
Yeah, or if it's McDonald's, maybe they want to build more McDonald's or more infrastructure.
Yeah, so capital reinvestment. Okay, and that's only, and I guess they'd see that as maybe just helping the company grow instead of issuing dividends, which shareholders, I guess, like. But then some shareholders I see could like the fact that, yep, they're not receiving dividends, but they know that the company is using that profit to reinvest in the company for it to grow more, to potentially make more of whatever it's selling. So that means more profits. Okay, which potentially could lead to maybe dividends down the track as the company's sort of built itself up and established itself. Okay.
Yeah.
Are there examples where companies like, I don't know, I know like the big 4 banks as an example, they usually make a lot of money. Well done, Australia. Just anyway.
Bravo.
I know during COVID there was a few shockwaves where a lot of companies that usually had a consistent track record with paying dividends. Did they sort of hold back on issuing profits to shareholders?
Yeah, there was instances where, there wasn't as many dividends or, like you said, cents to the share issued because of everything that happened with COVID.
And COVID's sort of the extreme case, but it is a case, isn't it, where especially in Australia, a lot of financial things sort of happened. Companies obviously lost a heap of revenue because everything had sort of shut down. So their profit margins weren't as big. A lot of companies were found out and I guess weren't as viable. And so what they kind of held off on releasing dividends for 3, 6, 12 months. Is that right? Okay.
Yeah.
So cool. So companies can use them in different ways. They can hold off on issuing dividends to either maybe reinvest back into the company to help it grow even further, or if they've had a bit of a contraction in their revenue, or if something like COVID's happened, they might use the cash amounts that they have just to get them through a bit of a tough period. So I guess, I can imagine, say, with mining companies, there are periods where they're not getting as much money for their commodities or they're just not mining as much.
Yeah.
So, okay, that might sort of lead them to pull back on how much dividends they provide to their shareholders. Okay, cool.
And I think a lot of people too might talk about, getting shares for dividends, in Australia. People like to think, I'll get lots of dividends if I invest in, one of the big 4 or like CBA, NAB. But do we get dividends on overseas shares, like if they're in the US?
You do. Whether it's US or Europe, still produce some sort of dividends, but I guess their taxation laws are quite different to Australia.
Yeah.
So I know in Australia, you generally companies that issue dividends, there'll be a thing attached to it called a franking credit or an imputation credit that comes with it. I guess the upside of Australia is the ATO, the Australian Taxation Office, doesn't want to sting the company double tax. So when a company, generally speaking, when a company makes profit, the ATO charges them 30 cents to the dollar on profit. That franking credit is then passed on to the shareholder.
Yay.
So that's okay. So that's where the franking credit comes from. But yes, to answer your question, yeah, you can get dividends from overseas companies, but they sort of find other ways to distribute to their shareholders where it's a bit more tax effective. I know in the US, the company will pay a certain amount of tax, and then the individual will then also pay tax on dividends as well. So it's kind of like a double whammy.
To be in Australia then.
Another reason maybe to not wear your red marga hat. Anyway, yeah, rock solid. I think they've tried to amend it, but not quite. No, I think Australia identified this possibly in the 80s that, hey, maybe we shouldn't sting Australians double tax because they might, I don't know, there might be an uproar and some sort of crazy rebellion. I don't know. A Eureka Stockade 2.0.
Yeah.
Okay, maybe not. Pitchforks and bad country music and the rest of it. Anyway.
Yeah.
Okay, so when are you going to find out? Sorry. Okay, scrub that from the edit. So when do you find out if you're going to get a dividend? And if I buy shares today, does that guarantee? Let's just say I find out that Commonwealth Bank's issuing dividends tomorrow, and I'm like, hot jam! I'm going to jump on the interweb, buy a heap of Commonwealth Bank shares. Will I receive that dividend tomorrow?
Most likely no.
Oh.
And that's because there's something called an ex-dividend date.
Yep.
Where whoever it is, did you say Commonwealth Bank?
Yeah, let's just say CBA. Yep.
They'll put out a date for the ex-dividend, and that means that you need to buy your shares before the ex-dividend date to get your dividends.
God, there's always a catch.
Yeah.
I thought I'd found the loophole of easy ride to wealth and retirement. So okay, so essentially what you're saying is they'll put an ex-dividend date out. If you buy shares after that date, you're not entitled to the potential dividend that they're going to release. Right. Okay, that kind of makes sense. And I guess that benefits some shareholders on top of the ones that are just buying it the day before or whatever. Okay, that makes a lot of sense. Okay, this I don't know. It's sounding quite good, this whole dividend thing. Maybe I should cut this podcast now and jump online and buy, I don't know, whatever's paying the most dividend.
He's already typing, guys. He's already buying.
Yeah, here we go. Okay, so how can you be paid dividends? Do they just send you this fat check in the mail, or is it via email, or can I have them distributed into my secret my secret holiday and boat fund account? Or so how does it work? Do they give you options when they're going to pay you a dividend?
Yeah, so you can either take the dividend as a cash. So you take, if it's like you said, 10 cents to the dollar.
Yep.
You take that 10 cents to the dollar as a dividend, put it in your boat fund.
Yep, secret boat fund.
Secret boat fund.
Yep.
Sorry, yep. And you can spend that however you want. Or some of them have the option to reinvest inside or back into the company. And how that kinds of looks is, if they give you $70 in dividends and one share costs, say, $70, they'll give you an extra share that you can buy.
Okay. So instead of cash in the bank that you can spend on, I don't know, shoes or, I don't know. Boats, you can then use that money to buy another share in that company. Right.
And do they usually discount the share price as well if you reinvest?
Yeah, I think they can. Sometimes they can, as well as sometimes, not all the time, generally speaking, you may even skip out on the fees that come with purchasing a new share. So sometimes that can happen. Usually, say if you've got an online brokerage account or whatever, you'll pay a purchasing or a transaction fee to buy X amount of shares. But as you mentioned, if the dividends are $70 and you opt into their dividend reinvestment plan, also known as DRIP, sometimes you will get a subsidized or even free fee for purchasing those new shares. So you're kind of saving a few cents to the dollar.
Yeah.
And it's letting you, I guess, compound interest or earnings on earnings. So
what happens if I get an $80 dividend and the share price is $70? What happens to that extra?
Good question. I thought you were answering all the questions today. You're definitely more adept at it, but I think
tossing it back.
That surplus amount is held kind of, I'm going to say in purgatory until the next dividend release sort of amount date, and then it's contributed to further dividend reinvestment.
So till the next quarter if it's paid quarterly.
It is, because not everything's in perfect maths. It could be, you're right, it could be $50 worth of dividends distributed, but shares might be $3.25, which buys you a whole heap of them, and there might be some change left over. That's kind of held until the next round. And if you've opted into the DRIP,
what's DRIP?
Dividend reinvestment plan. So you can essentially, once you own shares, you can opt to be part of that, and that will then sort of systematically buy more shares for you whenever the dividends are released. So next thing you know, in a couple of years, you've gone from holding 100 shares of a company, and next thing you know, you're holding 130, and you're like, hold on, I don't remember logging in and buying more shares. So that's news to me, but it's a bit of a win. So I guess that's and people can opt for different things, and not all companies will let you do a dividend reinvestment plan. Some will only just provide the option to send you a fat check, or I guess in these days, direct deposit, cash payment. So on this whole dividend thing, is this like a little sneaky side hustle where the ATO don't see that amount of profit that you're getting? Like, do you pay tax on that?
Yes. Yep. So you don't pay tax immediately on, say, the growth portion of your shares, but when you're getting dividends kind of paid out to you, whether you take them as cash or reinvest them back into the company, you do pay tax on whatever you receive.
Okay, let me wrap my head around this because I thought this was all
free money.
Yeah, tea and biscuits and good times. So you don't pay tax if a share price increases. Let's just say, I don't know, CBA shares go from $100 to $110.
Mm-hmm.
You won't pay tax on that share price growth. But if they pay you a dividend, $10 or whatever it is, that will go on your taxable income.
Yes.
The ATO will see that and go, hey, dude, you earned an extra $10 from some dividends. Okay, and that'll finalise itself at the end of the financial year when you do your tax return.
I think they actually automatically put it in your tax return now, so there's no way to evade it.
Everything is digitised and connected. Yeah. All right. So do they know about the money under my mattress at all?
Ooh, I don't think so.
Yeah, well, it's not like it's earning interest. So I guess if it's under my mattress, that means I don't hold any shares in any companies.
Is that for the secret boat too?
Shh. If my wife's out there listening, disregard everything that you just heard then. Okay. So I've noticed when we look at different companies, they provide a heap of different data, metrics and stuff. Why do some companies pay more dividends than other companies?
Well, that is a very good question.
Or does that come back to our initial sort of point on companies don't have to pay you a fat dividend. They can pay you a little bit, keep some of their profits to reinvest within that company. Is that sort of why?
Yeah, I think it makes it very attractive for shareholders to get paid out those dividends. So if you're, getting money every quarter, that's very attractive to some people. So it could be a reason for people to invest in that company. So that might be why they do it. Yeah.
And do you find with some of your clients or your experience, some clients might like companies that pay more of a dividend than others? Is that right?
Yeah, yeah. I think for people that are older, possibly as well, if if they're not working, they can get paid out the dividends plus the franking credits, which we'll go into in another episode. But
Wait, we're doing another episode?
957?
Yeah, good math. It was around there. Yeah. Yep.
But yeah, how do people, you hear the term dividend yield kind of thrown around.
Yep.
Especially in the media and stuff like that. What is dividend yield and how do you kind of figure it out?
Good question. Tough question. I thought I was going to answer that. No, I'll definitely answer it now. So dividend yield, usually that's what a company will, when they announce that, hey, we've made a profit, we are going to issue a dividend, and they'll usually announce that it's on a certain date, and on that date will be a certain share price, and they'll say the dividend yield is usually a percentage of that share price. So if you're holding CBA shares that are worth, say, $100, and they announce they're offering a dividend of 5%, you're essentially going to get a $5 dividend, depending on how many shares you hold.
That's more attractive if you have a higher dividend yield.
Yeah, well, the higher dividend yield is a higher percentage, yes. But it just comes down to the company. There are definitely some companies that provide higher yields or percentages, and some companies are as low. Look, there's some companies that might go, hey, we're issuing a 10% dividend yield, but their share price might only be $2 or $20. Whereas CBA, who I think is floating around the $150 mark, might go, hey, we're issuing a dividend this half year at 5% as an example, but that's 5% on $150 odd.
Yeah.
So it kind of changes, but that's essentially what a yield is a percentage of the share price, and that sort of gives you an indication what you're getting. Kind of like your interest rate. It's sort of, it's at a percentage, so it's very similar to that.
Yeah, yeah. You also kind of get the term PE or price to earnings ratio thrown about. Is that used to kind of value companies?
Sort of valuing companies, but it's definitely it gives you there's a multitude of ratios you can use to compare companies and their performances and their finance metrics. PE is used a lot when looking at or assessing a company. So price to earnings ratio, it might give you something that's in between 10 or a PE of 12 or a PE of 15. That's sort of highlighting the ratio of the price you'll pay for a share compared to what it's earning or paying you back. So every company is different. I guess as a general outline, sometimes it's a bit better when you're comparing PE ratios to compare two companies, if that's what you're doing, when you're comparing the PE ratios to sort of make sure that they're coming from a similar sector or industry background or so. It's very, you can't really sometimes, not that it's comparing apples with eggs, but comparing the PE ratio of a bank to the PE ratio of a mining company or a tech startup company or a entertainment company, because they kind of work in different sort of economic cycles.
Yeah.
So the PE ratios may be different. Some sectors have a higher ratio, just sort of naturally a higher ratio than other sectors.
Yeah, right.
So they all kind of they all differ.
What would it mean then if, just to throw numbers around, if CommBank or Commonwealth Bank had like a PE of 10?
Yep.
And then say NAB had in a similar sector, the banking sector or industry.
Yep.
They had a PE of 20.
Right.
What does that mean?
Yeah, it's a good question. I guess it comes back to, as we mentioned, the price to earnings ratio. So you're saying CBA at the time has a PE of 10, NAB has a PE of 20. So you're essentially going to pay double as much for the same earnings with NAB. So
it's the higher one.
Yeah, it's the higher one. And because they're very, very similar, they're in the same sort of sector. They do the same thing, which is banking and finance. So they're lending money to people or businesses or doing mortgages. One is a bit more expensive than the other regarding its potential earnings, and it's going to pay back to shareholders.
Yeah, right.
Yeah, so it's interesting one. Not that it should fully sway you on which company you're possibly going to buy shares in, but the PE ratio can sometimes give you a bit of an indication of which company might be performing a bit better than the other.
Yeah.
So as you mentioned, NAB might have PE of 20, which means it might be overvalued for some reason. So it could potentially mean that you're going to pay too much to buy that share.
Yeah.
And it could potentially sort of lead you into further investigation on the why. Why does it have a higher PE ratio? So and you'll see if you sort of go down the Google train, or Joogle as we like to call it, different sectors and the companies within those sectors will have different average PE ratios. Some are higher, some are lower. Some sectors are naturally, on an average, lower than some other ones. It just depends on their operating costs, profit margins, how they derive their revenue, all that kind of stuff.
Oh, interesting.
Yeah. All right.
Thanks, guys.
Ciao. We'll see you then.